There is simply no better way to become wealthy in America than successfully exiting a business. John Warlow, best-selling author of Built to Sell. As you know, being a business owner is one of the hardest, yet most fulfilling endeavors that you're ever going to experience in your life. Whether you're 100% focused on one company or building multiple businesses as a serial entrepreneur, and whether your business is primarily offline or online. But will your business journey ultimately end with a successful and prosperous exit that yields massive generational wealth for you and your family? Whether you want to parlay your windfall of cash into funding your next opportunity, experience a life of adventure and recreation, or ride off into the sunset and retire quietly with your millions? Or will it be a burden for which you did not prepare? Will you receive what you think you deserve for all the blood, sweat, and tears you've shed in the journey of running your business? The answer is that unless you proactively plan for such an event, your chances of a smooth and prosperous exit are about 1%. I'll explain that number in more detail in a few moments. That's the bad news, but there is also very good news if you pay attention and take action. First, a quick introduction. My name is Dan Kalis. My brother and business partner Joe and I are serial entrepreneurs, co-founders of the ExitWealth Accelerator, and certified advisors of the Value Builder System, which was founded and operated by the man I quoted earlier and is pictured with us here, John Warlow. By the way, there's nothing for sale during this recording. And at the end, the only thing we have to offer you is the opportunity to schedule a call with us to determine how ready you are for the biggest financial transaction in your life. Now, some good news. As a privately owned business owner or entrepreneur, you are part of an upcoming transfer of wealth at a level this country has never seen before. An estimated $10 trillion of asset value is tied up in the equity of small and mid-sized American businesses like yours. But it can only be harvested through a profitable liquidity event. In other words, the successful exit and sale of your company. The potential is there, but it requires proper planning, ideally 3 to 10 years ahead of time. Now, here's the big problem that you may not even be aware of. In a nutshell, 80% of businesses doing less than $10 million of annual revenue are unsellable, even the profitable ones. And only 1 out of 10 companies that are actually listed for sale with a broker end up closing. What's worse, of the 20% that do sell, only 5% of those business owners, so 1% total, are happy with the net sale proceeds according to surveys. Why? Well, there are actually 8 key drivers of company value and sellability according to research done by the Value Builder System on more than 40,000 businesses. The data simply doesn't lie. The other 7 drivers are just as important to making your business a well-oiled machine that the owner, you, can exit and sell at any time in order to retire, pursue new endeavors, or to properly deal with unplanned life challenges. By the way, one of the most common reasons a business is unsellable, even if it's profitable, is that it's too dependent on the involvement of the owner. So one of the best benefits of having a sellable business is that it can thrive without the owner managing the day-to-day operations. We refer to this as being caught in the owner's trap. I know that you know how that feels. So there really are 2 exits you need to prepare for. The first one is an exit from the day-to-day operations of your business, and the second is an exit from your company altogether. One of our mottos at ExitWealth is, ready or not, exit will come. And to avoid the terrible pain of regret, it is vital, not an option, to create and execute on a strategic exit and valuation acceleration plan. Those who don't plan ahead for their inevitable future exit will end up in that 80% of businesses that can't and won't sell, and in some cases, even go bankrupt. Just because this type of planning requires you to begin with the end in mind, though, it does not mean that you won't experience any positive changes until the end. A good exit plan strengthens the very infrastructure of your business, helps you dramatically improve cash flow, ensures that your corporate financials are airtight, defendable, and trending positively. It boosts customer loyalty and company reputation, and many, many other tangible benefits that yield optimal internal health for your business. In fact, we believe the most important KPI, key performance indicator, in your business isn't revenue or even profits, but the sellable value of the company. In other words, what someone else is willing to pay for the privilege of taking over and running your business. It's the most accurate and holistic recognition of the internal health of your company. So why isn't the topic of exit planning and valuation optimization talked about more among business owners, entrepreneurs, and by our various business advisors and vendors? The reality is that most mergers and acquisitions, investment banking, and private equity professionals totally ignore companies below $10 million in annual sales. And nearly all business brokers who do work with the smaller companies are 100% transaction-based, but they lack the time to educate or advise private business owners on this vital subject, leaving a void. And that's where we come in as advocates for the underserved, overlooked, and often manipulated sector of privately held businesses in America. A competent strategic exit planner and advisor is as important as any other member of a financial planning team, including your financial advisor, business broker, CPA, attorney, and banker. And just as important as any other type of consultant with marketing or business planning. If one of your business advisors referred you to us in this short presentation, please thank them for being so open-minded, forward-thinking, and concerned for your financial well-being. Exit planning and valuation optimization are the keys that unlock 6 times more wealth for business owners and ensure a smooth and lucrative future sale, which is why it's the business strategy that trumps all others. Your future quality of life depends on making this a priority, starting today. Now, without further ado, here's John Warlow to further describe the 8 drivers of company value and sellability, which is the foundation of the Value Builder system and the ExitWealth Accelerator methodology.
We discovered that there are these 8 key drivers that drive the sellability of a company. The first one's an easy one. It's easy to understand. It's actually very difficult to deliver. It's your financial performance, right? So it's made up of what's your top line revenue, what's your bottom line profit. And the interesting thing about financial performance is there's a second kind of hidden element to it. It's not only what those numbers are, but the quality of the reporting of those numbers. So to drive up your score, not only focus on your top line or your bottom line, but also consider investing in an audit or some way to make sure that those numbers are as defendable as you can. Because a buyer's going to come in and say, great, you've got these numbers, but how defendable are they? And what third party has come in to really scrutinize these? So investing in an audit is one simple way to improve your score on financial performance. You know, the second driver of sellability is growth potential. So a lot of business owners, when they think about their business, they want it valued on what they've done in the past, right? We're proud of what we've done in the past. That's normal. You know, the fact that you won an association award, for example, or that you've got a 20-year business, or that you're recognized for your reliability, whatever it is that you think you've done in the past. And the hard truth of it is that when a buyer comes in, they're not buying the past. They're not buying what you've done. They're really only buying one thing, and that is they're buying your future stream of profits. What is this business going to do in the future? For you, it's the end of the game. It's the finishing line. For them, it's the start. It's a different frame of mind. So for them, they want to understand, okay, what can this business do in the future? So to drive up your score on growth potential, you really want to make the case and focus on what is the future potential of this business. You know, can it operate in a different market? Let's say you've been successful in market A. Is it possible to scale this into market B, C, and D? Could you cross-sell additional products and services to your existing, customer base? Are there ways that this could work in different cultural markets, for example? All the ways that you could significantly scale up the business. The answer to those questions is going to drive up your growth potential. The Switzerland structure gets its name from the country of Switzerland. So if you know anything about the history of Switzerland, it's pretty amazing. They've taken this obsession with being independent. They didn't join either of the 2 world wars. They didn't send troops to Iraq. They didn't even join the United Nations, if you can believe this, before a referendum for the entire country to decide whether to join or not. They ultimately did. But it really goes to the idea that as a country, they're obsessed with this independence, not being overly dependent on any one faction or regime, so to speak. That's essential for building a sellable company, that independence of any one constituency. And the 3 most important groups you've got to make sure you are independent of are, number 1, customers. So you can't have an overly concentrated customer set. You've got to have good diversification among your customer set. Number 2, employees. So you can't be overly reliant on any one employee. And number 3, and this one's Obviously not sometimes as intuitive as the others. You can't be overly dependent on any one supplier either. So customer, employee, supplier, you've got to be independent of those three, because for a buyer coming in, they're going to look at your business, and if they see that you're overly dependent on any one of those constituencies, they're going to discount the business because it's just too risky for them. So to improve your score, you've really got to make sure you've got good diversification in your customers, make sure you're not overly reliant on any one employee, and you've got diversification in your suppliers as well. Do you remember when you were a kid, you go to the playground, you'd be on a teeter-totter. There's a light kid, and the heavier kid gets on, a light kid goes up. The same relationship exists between the way cash moves through your company and its value. And it's one of the drivers of sellability. Essentially, when a buyer comes and buys your business, they've actually got to write two checks. So they write a check to you, the owner, it's obvious. They have to write a second check that a lot of people don't really think about. And the second check is to fund your company's working capital. That's the money your business needs to operate the day you hand over the keys to the buyer. The deal is that the buyer has to write those two checks out of the same checkbook. So the more your company sucks up in the way of cash, the more cash your company needs to operate, the less they're going to be willing to buy your business. So the way to improve your score on the valuation teeter-totter is really to make sure that your business is generating cash. If you collect receivables, collect them faster. If you can extend your payables a little bit more, make sure you're delaying your payments to the point where you're just generating more cash as a business. And that's going to improve your score on the teeter-totter. When a buyer comes in to buy your business, they want to understand, okay, how's this business going to continue when you, the owner, leave? And so the more reoccurring revenue you can have, the more valuable it's going to be. And I found that there are really 6 different forms of recurring revenue, and buyers view each of the forms a little bit differently. I'm going to give you the 6, kind of like the David Letterman's top 10 list. I'll start from the lowest valuable one and end with the most valuable ones in the eyes of an acquirer. The first of the 6 forms of recurring revenue is simple consumables. So I'm a coffee drinker. I probably have 2 a day. So in the morning and usually after lunch, I've got a refill on coffee. So it's a simple consumables business. One step up the ladder is a sunk money consumable. So you've seen these Nespresso coffee makers where you've got the machine and then you buy the little capsules. That's called a sunk money subscription, because you've sunk money into the machine, you're way more likely to buy the capsules from the same company. Next one up the ladder is subscription revenue. So if you've ever subscribed to a magazine, you know about that, right? There's a start date and an end date to your subscription, and the editors know that you're a subscriber for either a year or 2 years into the future. It's a form of recurring revenue. One step up the ladder is sunk money subscriptions, where you sink money into a platform, and then you buy information or something on a subscription basis. A good example of that would be the Bloomberg terminal. Wall Street traders have the hardware, the physical computer that sits on their desk. That's called the Bloomberg terminal. They also buy the information on a subscription basis. So it's kind of mashing together 2 of these concepts, not only sunk money consumables, but also buying on a subscription. Auto renewal is the next rung up the ladder, where instead of having a start and a stop date to a subscription, it's in perpetuity. So, when you store documents, for example, with a document storage company like Iron Mountain, that's in perpetuity. They keep the documents until you say, send them back or shred them. And they just keep billing you on, a continuum basis. That's auto renewal or evergreen. The most valuable form of recurring revenue is contract revenue, where a customer is contractually obligated to buy from you into the future. And that, of course, is the most rock solid form of recurring revenue. So to improve your score on this attribute, what you want to try to do is both walk up this hierarchy of recurring revenue. Think of it as a ladder, moving up the rungs on the ladder. So if you've got subscription revenue today, think about if you could turn that into auto renewal subscription, or if you've got evergreen subscription, could you make those contracts? Once you can climb up as high as you can, you really want to focus on the proportion of recurring revenue. The ideal is 100%. Very few businesses get there, but the higher proportion of recurring revenue and the higher up the ladder you go, the more valuable your company is going to be. So the monopoly control is an attribute of sellability that means you've got control over how you price your product. You're not being commoditized, essentially, because you're unique and different in the marketplace. You've heard Warren Buffett, the famous investor, talk about this idea of having a deep and wide moat around your business. He's referring to the idea that he invests in companies that have a differentiated marketing position. A lot of investors look for companies that have a differentiated proposition because that gives you ability to control your pricing. The more you control your pricing, the more margin you make. The more margin you make, the more you can invest in sales and marketing, and it triggers this nice little domino effect that enables you to stay different in the marketplace. Again, the more different you are, the more control over you have of your pricing. So the way you can improve your score on the monopoly control is to really scrutinize the way you're marketing your business through two lenses. Because a marketing strategy has to have two attributes. It's got to be meaningful to customers, and it's got to make it different. So scrutinizing all the messages you have in the marketplace, so look at your website, the side of your vans, however you communicate to your market, and say, does this make us different? And do customers care? Those are the two drivers that drive up your monopoly control score. Customer satisfaction is an obvious driver of sellability, right? So obviously, how satisfied are your customers is going to be important to a buyer. Because when a buyer buys a company, they're buying the future. So when you leave and ride off into the sunset, they're going to want to know, how's this business going to be performing when you're gone, the owner? To drive up your score on this attribute, you've got to really quantify, empirically, quantitatively measure customer satisfaction. Probably the most well-liked, well-respected way to do that is something called the Net Promoter Score. You can Google it later, but essentially you're measuring and benchmarking your performance on the likelihood that your customers are going to recommend you. And the more you have that data, the more you'll know for your own peace of mind that your customers are satisfied, but the more acquirers will also be able to see that your customers are satisfied and likely to repurchase from you. Yeah, hub and spoke refers to how dependent your company is on you personally. Again, when an acquirer comes in to buy your business, they're going to want to know, how's this thing going to operate when you leave? And the more dependent the company is on you personally, the lower you're going to score on hub and spoke. You know, the name comes from 20 years ago. I was talking to a business owner and he was describing his role in the company. He said, I'm a hub in a hub and spoke model where all my employees come to me when they've got a question. My customers come to me when they need a quote. My suppliers come to me when they want me to buy something. And he was proud of that operating style, saying that, that's what makes his business efficient. Well, it may be efficient, but if you've ever flown through, Chicago O'Hare when there's a snowstorm and the hub breaks down, it gets locked up, it's a disaster. And so the same thing is true of a hub and spoke business owner. When everything is dependent on the hub and spoke or that hub manager, there's not much value left in the company. So the key here is to improve your score on hub and spoke is to make sure your business becomes less dependent on you personally. And one of the quick ways you can do that is to start documenting your processes, right? So if you have ways of doing things, get them down on paper. Make sure employees are aware of the 7 steps to close up at night or the 3 ways that we change our brand or the things that are important to us as a company, our values and so forth. Make sure all this stuff is not just in your head, but expressed, written down so that employees can read it, digest it, and operate when you're not there. One of the fun ways you can measure how you're doing on hub and spoke is to take a vacation. Start small, take a couple days, and just see how your business operates when you're not there. Come back, find out where the breakdowns were, and start plugging those holes. Again, with training, process improvement, making sure things are documented for employees. Take another vacation, make it a week or 2, and again, see how the business performs, because it's at those points of where the business breaks down, you've got to reinforce before you're going to score better on hub and spoke. Here at Value Builder, we believe that right now, business owners are at a real disadvantage when they go to sell their company. Because across the negotiating table from the business owner, from you, is oftentimes a mercenary private equity partner or a clinical corporate development executive from a big company, someone whose job 24/7, 7 days a week is buying companies, and they're good at it. And they know all the tricks to manipulate you to sell your business for less than it's worth. And our mission as a company is to change that. We want to give business owners the information, the insight, the education they need to really fight back and get a fair price for
their company. So that's kind of what we're all about as a business. Our mission is to be serving 1 million small businesses by the year 2030. Right now, we have 34,000 businesses we've impacted through the Value Builder questionnaire. So that's our long-term mission. And we feel pretty good about the ability to reach it and the value that we're adding, because what we see is in the metrics, it's actually working. So when you start with us, you may have already done this. If not, your certified value builder will certainly encourage you to do this. You're going to complete a 13-minute questionnaire. It's called the Value Builder Questionnaire. And if you go through it, you're going to get a score out of 100. Now, the average score among all of our users is 59 out of a possible 100. And when we ask those businesses, hey, did you sell your company? And if so, what multiple did you get the offer for? What multiple of your earnings was that offer for? The average business is getting offers of 3.5 times their pre-tax profit. And by the way, when we express pre-tax profit, we ask you to make some basic adjustments so that there's a market rate salary for the owner included in your profitability. So using that as a measure, the average business is getting an offer of 3.5 times pre-tax profit. Yet when we look at businesses that achieve 90 or more on the Value Builder questionnaire, so these would be our best performers. So these are sort of our all-stars. These people are getting offers of 7.1 times their pre-tax profit. So more than double the average business. So we know that if you work with your certified value builder over time and you work to enhance your score, it's going to have a material impact on the value of your company. It's also going to improve the likelihood that you get an offer, that you could actually sell your business. Because what I've got up in front of you now is a new chart that shows you the proportion of our users who have received a written offer in the last 12 months. And again, the average performer on our score out of 100 gets 59. And 12.3% of those businesses have received a written offer in the last 12 months. Yet when we isolate the cohort of 90 plus users, you can see that fully a third of those businesses have received an offer, more than two, almost 3 times more likely to receive an offer. So look, if you take what I'm about to share with you to heart and you make the changes in your business and you go about improving your value builder score, it's going to have a material impact on not only the likelihood that you're going to get an offer, but also that you're going to be pleased and impressed with the offer that you get. So I think there's a lot at stake in our session today. Just to give you a sense of our users, it actually falls really closely in line with what you shared in the poll results were your situation. So some of our users, I would say a minority generally, are ready to sell their business now. A bigger chunk really want to increase the value of their business. And then there's some that really just want more of an enjoyable business to run. When we look at the Value Builder users, what we see first and foremost is that company size does impact the value of your company. So what you're looking at right now is the multiple offered our users, again, 34,000 of them now and counting, the multiple offered different size of companies. So overall, when we look at all of our users, it's around 3.6 times pre-tax profit. This data was pulled a few months prior to the last data I showed you, which is why there's a very slight difference between the overall number. Yet if we look at the very smallest companies, you see that they trade at a much lower multiple, less than 3 times. If we look at 1 to 3 million, they're about average. 3 to 10, better than average. And then the guys who are at the 10 plus tier are getting much better multiples, sort of 1.5 times pre-tax profit, or 1.5 time turns better than the average. The other thing you said drives the value of your company is the industry that you're in. And again, what we see when we break out our users by industry vertical, these are called NAICS codes. You may have even referred to them as SIC codes, SIC codes. They're now referred to as NAICS codes. If we look at NAICS codes, you can see that there's a big variance. For example, manufacturing companies doing quite well at 4.5 times pre-tax profit. And then there's this lowly sector down here called administrative and support and waste management, who are getting just 1.8 times their pre-tax profit. And so you're right. I think industry does drive the value of your company. It's going to be an important factor that impacts the value of your company. But it's not the only thing. And in fact, I think there are other factors that are more important than the industry you're in or the revenue that you have. And the reason I say that with some degree of confidence is a woman named Jill Nelson. So you're looking at a woman on screen right now named Jill. Jill Nelson started a company called Ruby Receptionists. Well, Jill built this little company up in the administrative and support management SIC code up to $11 million in annual revenue. Okay, so $11 million in annual revenue. Let's imagine, I mean, it's a services business. Let's imagine she's able to eke out 10% profit margin. So let's imagine she's got $1 million in profits. And I just showed you that an administrative support company would typically trade at about 1.8 times profit, right? So let's imagine she's got $1 million in profit, just to keep things easy. She's trading at 1.8 times $1 million. So let's, it would be safe to assume that if all you cared about her and you thought the only thing that drives the value of your company was industry, that her business would be worth around $2 million. $1 million of profit times 1.8 multiple of profit. Well, Jill recently sold her company for a cool $38.8 million. She's in the administrative and waste management space, an industry that on the whole trades at a discounted multiple. But somehow Jill structured her business along these 8 key drivers of company value to the tune that she was able to drive almost 4 times top line revenue for her company. An astronomical multiple by any measure. So there must be something else. It can't just be what revenue you have and what profit you have that is going to drive the value of your company. There must be other factors. And that's really what I want to talk about now. The other factors are these drivers that we see that go beyond industry and revenue that are impacting the value of a business. The first of which is recurring revenue. There's no way around it. The more recurring revenue you have, the more valuable your business is going to be. If we look at average multiple versus those with at least 3/4 of the revenue coming from recurring sources, the businesses with recurring revenue are getting much better multiples. Now you may be asking, okay, well, what do I mean by recurring revenue? I mean revenue that is going to come in without having to stimulate the customer to buy. In other words, the customer has to make an opt-out decision rather than an opt-in decision. You're going to bill them unless they tell you to stop. So this would be things like subscriptions, service contracts, annuities, anything where there's a kind of tail to the revenue. Those businesses are trading at a much better multiple than those businesses without recurring revenue. Now, you may be saying, oh, well, that's nice if I own a software company, or if I was a wealth management firm, I'd have an annuity. But, I'm in a distribution company. I'm in a manufacturing business. I'm in a retail company. It doesn't work that way in my industry. And when I hear that, and what I'd love you to do is sort of crack your mind open to the fact that no matter what industry you're in, you actually can create some recurring revenue. I feel confident in saying that in part because of the story of H. Bloom. So H. Bloom, if you haven't heard of them, this is a company in a terrible industry. It's in the business of selling flowers. And so if you've ever looked at the economics of selling flowers, it is just a terrible, terrible dogfight of an industry. So first of all, you've got 2 days of the calendar year where people buy flowers, right? Mother's Day and Valentine's Day drive more than 1/3 of all flower sales. So if you're a flower store owner, you've got to hire extra staff, part-time staff, work till midnight around those 2 holidays, and then lay everybody off for the next 363 days because you've got no revenue, right? Because people don't buy flowers without an occasion. And so there's tremendous seasonality in these businesses. Not only that, the inventory, and in this case, the flowers, starts dying the moment the farmer cuts it off the leaf. In fact, after a month of being in your refrigerator, the flowers are rotting. They're dead. You can't sell them. Typical flower store in America will throw out more than 60% of its inventory. Think about that. 60% of your cost of goods sold gets put in the garbage as wastage because you guessed wrong. Well, along come these 2 guys, Son Yu Panda on the left, Brian Burkhart on the right. And they say, look, we're going to get into the business of selling flowers, which is an industry wrought with problems, as I've just pointed out. But we're going to do it in a unique way. We're going to get into the business of selling flowers on subscription. We're going to go around to the hotels, the spas, the wealth management companies who want to have a sort of prestigious image and want fresh cut flowers on the reception table. And we're going to sell them a subscription to flowers. We're going to pitch them on the idea that they're too busy to replace their old flowers. We'll come every 2 weeks. We'll get rid of the old flowers and we'll replenish them with brand new flowers. We'll send you a commercial grade invoice at the end of every month, just like another business would. And you can sort of forget about the flowers on your reception table, get back to what you do best. Well, I had a chance to interview Sonyu Panda, and I asked him sort of what's the best thing about a recurring revenue model, and he actually didn't say it's the value of the business. What he said was it's the predictability of the business, and I said, tell me more about that. And he said, well, at H. Bloom, we throw out less than 2% of our inventory every single month. Why? Well, we only buy the right amount of flowers for the customers that we have, right? So we know the Hilton Atlanta wants roses, and we know the daffodils go to the San Francisco Ritz-Carlton. So we only buy the amount of flowers we need. So we don't have spoilage. Again, compare that to the typical flower store who has 60% spoilage rates. Not only that, they've got recurring predictable revenue. At H. Bloom, the average lifetime value of a subscriber is more than $4,000, $4,500. And compare that to the average transaction in a retail flower store in America, last time I checked, was $29. Which company would you rather own? So recurring revenue, I don't care what industry you're in. It can be, we've seen it in legal practices and dental practices. We've seen it in manufacturing companies, distribution companies, restaurants. Across the board, the companies that create recurring revenue will be more valuable, period, full stop. And the H. Bloom story hopefully just cracks your mind open to the fact that no matter what industry you're in, you can create, if you're willing to think creatively enough, some recurring revenue. So that's my first piece of advice, is go beyond industry, go beyond the SIC code you're in or the revenue that you have, and create some recurring revenue. Number 2 on our list of drivers of value that are more important than the revenue that you have and the industry that you're in is something we call the monopoly control. You've probably heard Warren Buffett's famous annual letter. He's obviously a prolific speaker and does lots of presentations. You probably heard him say that he invests in companies with a deep and wide competitive moat. Right. So for him, he places a premium, a valuation premium, and goes out and buys companies that have the ability to compete because they don't have competitive threats. And so what he's looking at are companies with a point of differentiation. Why? Because a point of differentiation, something that makes you unique from your competitors, gives you more pricing authority. Right? So if you've got pricing authority, to some extent, you can set the price for your product, right? Because it's not, the demand is somewhat inelastic, right? So because it's something truly unique, you've got a little bit more pricing authority. When you've got more pricing authority, you can then invest more in sales and marketing. Invest more in sales and marketing, you can further differentiate your product or service from its competitors. And it sort of is the lead domino on this sort of trickle-down effect that creates a very deep and wide competitive moat. And that's why companies buy another business. If you think about it, if you put yourself in the shoes of an acquirer, right? And you say, what do I care about? What do I want to go buy this business for? They're making a buy versus build decision. When they evaluate your business, they're going to say, they probably won't tell you this, but they're going to think in their mind, can we just replicate what these guys have created? Right? If the barrier to entry, you don't have something truly unique. If you're selling by the inch and by the pound or replying to RFPs, if the barrier to entry is very, very low, they're going to say, why would we buy this business? Why don't we just drop our prices by 10%? We'll pick up all the business they're buying based on commoditization, and we'll have all their business, and we won't even have to write a check to buy it. So they're going to make a different decision if your business is truly unique. If you have truly a point of differentiation, that to create a business like yours would take years and millions and millions and millions of dollars of investment in sales and marketing, well, that's where they're going to write a check for you to buy your business, because to create what you've created would take years and many multiples of millions of dollars to create. That's when you see the tremendous multiples being paid. Again, we go back to the value builder data. Businesses, the average business at this point in time, then we compare it to those businesses that say they have a monopoly on the product or service that they sell. Companies with a monopoly are getting much better multiples than the average performing business. Something that you do that nobody else does is what makes you attractive to an acquirer. Again, if you're just selling a whole litany of commoditized products and services, nobody's going to buy your business for a premium. Even if they do buy it, it's going to be very low multiple because, again, they're going to just reason that if you're just doing another service just like everybody else, that they could win all of your business by virtually just dropping their price. They pay a premium to acquirers when there's something truly unique in what you do. It's either a process or a product that is truly unique. Which brings me to the story of Stephanie Breedlove. So Stephanie is a mom. She's got 2 kids, so ages 26 and 24. When they were born, she was working at the old Anderson Consultant. When I say old, it was the predecessor to what we now know as Accenture. She and her husband were sort of young, up-and-coming associates at Anderson, and they had their first child. And like good accountants, they wanted to pay their nanny legitimately. They didn't want to pay the nanny cash, which a lot of people do, obviously. They wanted to pay them legitimately. And so Stephanie calls up ADP. And she says, look, I'm from Texas. I want to pay my nanny. And her phone call gets bounced around between like 4 or 5 different departments at ADP, and each one less interested than the next in setting up her account. Why? Well, because people at ADP get paid bonuses for setting up large scale accounts, right? So Xerox wants to pay 20,000 employees. That's a deal that ADP wants. GM wants to, pay 50,000 factory workers. That's a deal that ADP wants. They don't want to pay some payroll for some nanny in Texas. After the 4th or 5th time her call gets rerouted, Stephanie has a bit of a light bulb moment. She says to herself, what if we started a payroll company just for parents to pay their nanny? If that's all we did, when somebody called us, we treat them with respect. We'd know the formula for setting up a nanny on payroll much faster than these people at ADP who never do it. Well, Breedlove took that insight and started a company called Breedlove and Associates, her surname, Breedlove and Associates. She built it up over the next 25 years to $9 million in annual revenue. Look, guys, this is not rocket science. This is not a company growing at 50% year over year. This is not the next Google, the next Apple, the next Tesla. This is a $9 million payroll services company. Nothing fancy. She sold the business recently for $54 million. How on earth do you sell a $9 million company for $54 million? Again, if we go back to the NAICS codes that Stephanie finds herself in, she would trade at about 3.5 times profit. She's trading at 6 times revenue. Unheard of multiple. Why would she trade at such a ridiculous multiple? Well, it comes down to a key decision she made very early on in her business. And the key decision was, how should she grow? She reached a point at $300,000 in revenue. It was just her and one junior associate in her company, $300,000 in revenue, when she was trying to figure out how to grow the business because she'd sort of plateaued. And she had 2 very different strategies she could pursue. One strategy on the left-hand side of your chart here was that she could sell more stuff to the parents that she was already selling payroll services to. So at the time, she was already doing payroll services for nannies. She successfully won a few parents. And every business pundit that was allowed to get on a stage at the time was saying the secret to growing 10x is to cross-sell your existing customers. You've heard things like, well, it's 9 times easier to sell an existing customer than it is to go find a new customer. So the prevailing wisdom at the time was go cross-sell your existing customers, because busy parents need lots of stuff, right? So busy parents, paying a nanny, they probably want to pay and outsource their lawn care. Maybe they've got snow removal needs in the wintertime. There are probably all sorts of services you could cross-sell busy parents paying a nanny. The other strategy was to go find more parents. to stick to what she knew was her point of differentiation, which was doing payroll for nannies. And instead of taking the easy route of cross-selling those parents other stuff, to take the very difficult route of go find more parents with nannies to pay. Well, long story short, she took the harder route, the route where she was looking for more parents with nannies to pay. She built the company up to $9 million in revenue. At the time, she had roughly, if my memory serves, about 10,000 customers when she sold it. How did she get $54 million for this business? Well, she sold it to a company called Care.com. Care.com is the Angie's List of care providers. So if you go in, pull up a web browser and you type in your postal code or your zip code into Care.com's browser, you will get a pre-selected, vetted, peer-rated group of nannies. By definition, all of their 7 million subscribers needed to pay a nanny, almost by default. They had 7 million subscribers. At the time Breedlove sold, they had 10,000 customers. Well, if you can imagine, Care.com's thinking, wow, if we can sell payroll services to just 1% of our customers, well, that's 70,000 customers. Right now, Breedlove is a $9 million business with 10,000 customers. We could literally overnight flip the switch and be 7 times the size, make Breedlove, the payroll service company, 7 times the size if just 1% of our users bought in. What if 2% bought in, or 5%, or even 10% of our users bought Breedlove payroll services? You could start to see how Breedlove and Associates as a company was worth a tremendous amount in the hands of Care.com, which is how she sold her business for $54 million, even though it was just a $9 million company. Because she had the courage and the discipline to do one thing better than anybody else and to avoid what we call the owner's trap. So the owner's trap happens very simply. Here's what happens. A lot of business owners start off, when they start selling their product or service. They've got something that they want to go sell. There's an idea, right? Like Stephanie Breedlove, she decided she wanted to go sell payroll for nannies. Well, pretty quickly, customers start asking you for more and more things, right? In Breedlove's case, they were saying, hey, we got to pay for, we got a snow removal. We've got all these other things that we need as busy parents that, relatively affluent, have a nanny to pay. We've got other services. And the danger that we get into, and the mistake so many of us as entrepreneurs make, is we start agreeing to sell other things outside of our unique point of differentiation. When we sell too many things, the only person that can deliver is you, the owner, because you can't train employees to do 50 different things. Employees, unlike you, the owner, employees thrive on repetition, right? So when you're doing payroll for nannies, guess what? They get really good at doing that, right? But if you're doing payroll for nannies and firemen and office workers and construction workers, guess what? You lose that point of differentiation. You lose the efficiency. When employees can't be the only ones that deliver, when owners are the only ones that can really deliver, guess what? Customers want to deal with the owner. And all of a sudden, you get trapped where you can't grow beyond a certain point. It may happen at $300,000 in revenue, may happen at $1 million in revenue, $5 million in revenue. Doesn't matter. But the telltale sign you're in the owner's trap is that you're flatline growth, you're plateaued, especially in an economy like we have today, where unemployment is virtually non-existent. The economy is screaming at a huge clip. If you're flat or down, you're in the owner's trap. Is one very common diagnosis. And so the way out is a real headspace shift. And it sounds easy for me to say, and frankly, it is easy for me to say, but it's very difficult to go do. What a lot of businesses, the secret to sort of pulling yourself out of the owner's trap is right now, if you're selling lots of things to 1 or 2 customers, to do almost the opposite, which is to sell just a few things to lots of customers. That may sound like a turn of phrase, like I just said the same thing in a different way. I actually said 180-degree different. So in the beginning, what a lot of small businesses do is they start off selling lots of things to a few people, a few companies. And the most valuable businesses like Stephanie Breedlove's do exactly the opposite. They do one thing, payroll for nannies, and sell it to lots of people. That's the headspace switch I think you need to get out of, or get into, if you will, to get out of the owner's trap. Number 3 on our list of sort of things that drive the value of your company are the degree to which your customers are willing to refer you. So if you could put yourself in the shoes of a buyer for a minute and try to think about what they would do to really evaluate your business if they were thinking about making you an acquisition offer. One of the things they're going to try to do is evaluate the satisfaction levels of your customers, excuse me. They're going to try to figure out, are these customers happy? Are they going to likely to repeat purchase, going back to recurring revenue? And one of the proxies they use for that is something called the Net Promoter Score. You may have heard of Net Promoter Score. It was developed by a guy named Fred Reichheld, a Bain consultant. He started a company called SAP Matrix, which is the one that really owns the intellectual property around Net Promoter Score. Net Promoter Score is a way to measure the likelihood that your clients are going to take one of two behaviors. They're either going to repurchase from you or refer you. And if you think about the raw material that is really necessary to grow a company, it's repeat customers who are referring their friends, which is why when you track the growth rate of average performing businesses, using the white line here over a 20-year period, and in the orange line, ideal companies that are achieving really high scores on Net Promoter Score, so some of the best performers, you could see that they grow at a rate 2x that of the average performing business. So the real market leaders on Net Promoter Score are people like Apple and Google and Eventbrite and Harley Davidson, and they're growing at a rate much more quickly than the average performing business. Why? Well, Net Promoter Score is predictive of your growth rate as a company, and it's predicting. It is so predictive because it is correlated to a customer of yours taking one of two behaviors. Again, either repurchasing for your company or referring you as a business. So the next thing I would recommend you do once you've picked a point of differentiation like Stephanie Breedlove and you've got recurring revenue like Jill Nelson does and others, is to start measuring and improving your Net Promoter Score. And so to do that, what you're going to do is survey a group of your customers, and you're going to ask them one simple question. On a scale of 0 to 10, how likely are you to recommend us to a friend or colleague? I'll say that again. On a scale of 0 to 10, how likely are you to recommend us to a friend or colleague? And then you're going to categorize your responses into one of 3 buckets. You're going to have a group, hopefully it's a big group, of what Reichheld calls promoters. These are the folks who gave you a 9 or a 10 on that 11-point scale, 0 to 10, how likely are you to recommend us? The 9s or 10s are your promoters. Let's imagine a hypothetical company that gets 25% promoters. Now, you're likely to have a fairly big group of what are called passives. And these are people who give you a 7 or an 8. Not particularly satisfied, not particularly likely to repurchase or to refer you, but also not likely to badmouth you. And then hopefully you have a relatively small bucket of what are called detractors. These are the guys who give you anything from a 0 all the way up to a 6. These are the people that are actively bad-mouthing you in the marketplace and very unlikely to repurchase. And if you look at the proportion in this hypothetical example, we've got 5% here. And so to figure out your Net Promoter Score, you simply take your percentage of promoters, in this case, 25%. You subtract your percentage of detractors, in this case, 5%, and you're left with 20%. And now if this was a real life example, it's not, it's just hypothetical, but if it was real life, it would actually be above average company compared to Reichheld's work. In Reichheld's work, he found the average Net Promoter Score among large enterprise companies that he worked with is between 10 and 15%. So 20% would actually be pretty good. Stephanie Breedlove, in contrast, achieved a Net Promoter Score consistently above 70. And at a point when her business was acquired, it was 78%. Again, because Net Promoter Score is a net number, you're taking your percentage of promoters, you're subtracting your percentage of detractors. Anything over 50% is considered world-class, reserved for only the best of the best brands. Virtually nobody achieves in the 70s, and Breedlove was at 78. How did she do that? Well, in part, when you call Breedlove and Associates, instead of getting the most junior employee, which you do at ADP, who want to, if you're going to set up payroll for nannies, you get the most seasoned customer service representative when you call Breedlove Associates and want to set up payroll for nannies, because they know that that onboarding experience is the very predictor of net promoter score for the lifetime of that relationship. If they can get that right and make that onboarding experience favorable, they know that they're going to have a promoter for life. So that's the next advice that I have. It's not just Reichheld that thinks this is important. Blackbird Ventures, all kinds of private equity companies, venture capitalists, virtually every large enterprise company from FedEx to GE to IBM to Apple to Marriott to Google all use Net Promoter Score. So if you want to be in that kind of company and allow those businesses to compare themselves apples to apples against you, you're going to want to use the Net Promoter Score as a way to predict the future growth rate of your company. Okay, guys, two drivers left. The next one is what I call the Switzerland structure. And again, this is informed by or kind of inspired by the country of Switzerland. So, Switzerland, I've got it here on this map in front of you where it's this kind of little red country. You can see it's red on your screen, I should say. It's colored red. It's landlocked. It's sort of sandwiched in between France, Italy, Germany. It has no business being, an independent sort of entity, yet it is fiercely independent, right? So if you know anything about the geopolitical history of Switzerland, it is fiercely independent, right? So they didn't join either World War I or World War II. They didn't join or send troops to Afghanistan or Iraq. They didn't join the Eurozone currency. They even had, if you imagine, they had a countrywide referendum on whether or not to join the UN. Like, who's not part of the UN? Like, maybe 3 countries, 3 sort of dictatorships are not part of the UN, and Switzerland can't just join the UN. They've got to have a countrywide referendum whether or not to join. I mean, these guys are obsessed with independence. And I want you to remember that story of how obsessed Switzerland is with their independence, not cozying up to any one geopolitical faction or regime of the day. I want you to remember that obsession with independence, because it can serve you well when it comes to the value of your business, because the most valuable businesses are independent of any of the 3 legs of the stool where companies often get dependent on. So they're independent of any one customer, any one employee, or any one supplier. And the person that they are dependent on in your company, if we look at one of those factors, employees, suppliers, and people in your company, the most likely person that your company is dependent on is actually you, the owner. And again, we ask that on the Value Bidder questionnaire. We say, describe for us the relationship you have with your customers. Again, average life of the tool. For those people, those business owners who told us, you know what, I know each of my customers by first name. I know their spouse's name. I know their dog's name. I am super customer-centric. Well, as customer-centric as that may sound, and it is, it's also dragging down the value of their business, because businesses that have a personal relationship, owners that have personal relationship with their customers, are getting much lower multiples when compared to those people who say, owners, CEOs who say, I don't know my customers personally, and I rarely get involved in serving an individual customer. Those businesses are getting the very best multiples. So it brings me to the story of, and I think it's a bit of a cautionary story, frankly, of Rick. So Rick Day is a guy who owns a company, or used to own a company, called Daycom Systems. So Daycom, you probably know businesses like this. Daycom is in the business of installing phone systems, right? So if you've got a phone system in your business, and maybe you've got a Cisco system, or in the old days they were Mitel systems or Nortel systems, these are the guys that install these systems. They're a value-added reseller or an integrator of these sorts of systems. So they didn't manufacture the systems, but they integrated them. And Rick built this business up to $26 million in revenue. So on the outside was a tremendous successful business, right? So more than 100 employees, was a pillar of the economy. Like, everybody knew Rick in town. He was sort of a big wheel. What Rick didn't share with the public was that he was becoming overly reliant on one supplier, and that supplier was Avaya. So Avaya makes phone systems, and so Avaya started to kind of cozy up to Rick and said, look, if you spec out Avaya gear for more and more of your customers, we'll give you better terms. We'll give you better rebates and better spiffs. We'll kind of make this worth your while. So much so that by the end, when Rick decided he wanted to sell his company, more than 90% of his jobs were spec'd out with Avaya gear. And so Rick one day decides that he wants to sell his business and goes around to a number of different people, and all of them had the same response. Well, what if Avaya changes business strategy? You're too dependent on this one supplier called Avaya. What if Avaya goes bankrupt? What if it changes its pricing strategy? What if it goes direct and gets rid of value-added resellers? You're out of business. Rick didn't have an answer from them because he was too dependent on one supplier, one of the three legs of the Switzerland structured stool. So he sold his business for 4 times EBITDA, which for a $26 million business is a bit of a discount in and of itself, right? As I shared with you in the very beginning, a $26 million business should be getting more like 5 or 6 or 7 times EBITDA, but he only got 4. What's really shocking, though, is when you look at how that 4 was paid, it was 40% up front, 40% in a 3-year note, and 20% was actually in an earnout. And if you know anything about earnouts, you know that they're at risk, right? It's not a guaranteed payment. So most sort of skeptical people evaluating this deal would say, well, he actually sold for 80% of 4 times EBITDA, so just a hair over 3 times EBITDA. For a $26 million business, that's a pretty big discount. And again, it's because in large measure, he was too dependent on a single supplier. And so for you to really maximize your score on this attribute, what you really want to do is ensure your business is not too dependent on a single customer. 15% revenue coming from any one customer would be where sort of a red flag gets waved and says, that's a little bit too high. So make sure that no one customer represents, if you can, more than 15% of your revenue. They also want to make sure that there is no dependency from a supplier perspective, that not all of your supply is coming from one vendor, that you become overly dependent on that one supplier, or that you become overly dependent on a single employee. Next up, we've got growth potential. And so growth potential, if we, again, go back to the Value Builder numbers, one of the questions we ask on the Value Builder questionnaire is, if you imagine for a second you had 5 times more demand for your product literally overnight. If you wake up one morning and literally there are 5 times more customers knocking on your door wanting to buy from you the next day, how easy, or by contrast, impossible would it be for you to accommodate that level of demand? Again, average multiple life of the tool, those who said, you know what, it would be actually impossible for us to accommodate 5x demand. I mean, like, think of the law firm. They'd have to go hire 5 times more lawyers, 5 times more associates. They'd have to get 5 times more office space. I mean, it would just be virtually impossible to handle 5 times more cases overnight. Those businesses who could not grow quickly or scale overnight are getting big discounts compared to those who say, you know what, it'd be relatively easy for us to accommodate 5x more demand. Netflix as an example. I think of Netflix and I think, how would Netflix, deal with 5 times more demand? Well, probably pretty well. They'd probably have to spin up 2 or 3 new servers. They might have to spark up a couple of new IP addresses to sort of accommodate 5x more load on their servers, but it's probably a matter of a few phone calls for them to be able to accommodate 5 times more customers. By contrast, if you're a law firm, boy, that's a tough business to scale that quickly. And so the message I want you to remember is businesses that can scale, that an acquirer looks at and says, man, there's a lot of growth potential in this business, are ones that get paid, that get purchased for a premium. And again, it's not rocket science. When you think about it, if you're thinking about it from an acquirer's perspective, right, they want to know, to use a farming analogy, that there's some field to go harvest, right? If you've harvested 95% of the field already and you've reached, you've maxed out the growth potential of your business, you think, okay, now it's time to sell. Well, an acquirer is going to look at that and say, well, there's not much more I can do with this thing. There's not more growth potential left. And so they're going to pay you maybe a deep discount for a value-based asset, as opposed to a growth-oriented multiple for a company that has lots of future potential. Which brings me to the story of Rod Drury. So you may recognize this name. He's now running one of the unicorn businesses valued at more than $1 billion. He owns a company called Xero, which is in a sort of a Coke Pepsi dogfight with Intuit, the makers of QuickBooks accounting software, to be the #1 online accounting platform in the world. They're huge in Asia Pac, less dominant here in the United States, but they're a very big player in Asia. And the company's called Xero. Well, what you may not know about Rod is that he got the money to start Xero from selling another company called Aftermail. What was Aftermail? Well, Aftermail was this goofy little company that came out around Sarbanes-Oxley. Do you remember that legislation, Sarbanes-Oxley, where you had to sort of take care of and archive and keep all of your old email? Well, Aftermail, as the name suggests, enables you to get your mail off your primary servers, but allows you to store it in case you ever get called upon to have a need for that stored email. Its company was called Aftermail, a software solution. Well, Rod built this little company up with two customers, two large enterprise sort of kind of charter customers, if you will, where he sold them a subscription to Aftermail, about $1 million each per year in AR and revenue per customer. So he's generating about $1 million per customer. He had two customers, both of whom were in the Fortune 500. Now, most of us as entrepreneurs would say, well, this is fantastic. We've got ourselves a tiger by the tail here. Why don't we go build this company up? Because there's another 498 Fortune 500 companies that probably need the very same software. Let's go. Let's hire a sales force. Rod did something different. Rod went to a systems integrator, a technology company, services business that had virtually all of the Fortune 500 companies as customers. And he said, look, I could go compete with you and sell them this service and over the next 20 years probably win a lot of business. Or I could just sell you this company and you could just go harvest all of the 498 companies that I haven't already sold to because you're already doing business with them today. Well, that systems integrator bought Rod's pitch and bought his business for a cool $35 million, 15 of which was upfront. And if you're following along at home, that means 7.5 times top line revenue. Again, and absolutely, I don't want to leave you with the impression that that's a realistic multiple. That is an insane multiple, an absolutely unheard of multiple for a $2 million business. But it was made possible because he made the case that there was enormous growth potential in what he created and that could scale very, very quickly without having to hire a bunch of people, taking on a bunch of office space. They bought that message and realized what it was worth in their hands was much more than it was worth in Rod's hands. So what you want to do is make sure that you leave some field left to plow, which leads me to my final sort of chart here. We started off this discussion today with a bit of an overview of, hey, listen, you know, a lot of us as business owners think that the value of our company is going to come down to what industry we're in. There's a rule of thumb. HVAC companies sell for 1 times revenue, or plumbing companies sell for 4 times, pre-tax profit, or whatever the numbers are. We've heard these multiples on the golf course or what have you. And to some extent, they're true. We do see that both industry and revenue do drive the value of your company, but that's not the end of the story. To be one of these outliers, to be one of these tremendously successful exits, you have to have more. You have to have things like recurring revenue, focusing on one thing that you do better than anybody else, just like Stephanie Breedlove, who had the discipline of picking payroll for nannies. Measure your net promoter score. If you can get your net promoter score above 50%, that is a strong predictor both to you as the owner as well as to an acquirer that your company is likely to grow. Make sure you reduce, as in the Switzerland structure, your reliance on a single customer, employee, or supplier. And then finally, leave some field, as Rod Drury did, left to plow. Make sure that you're not sopping up all the market share and then selling a business that's sort of past its prime. If you want to get a maximum multiple for your business, make sure that you're leaving some field left to plow for the next buyer. You were likely invited to this session by a certified value builder. And to give you a sense of how we work, we help businesses all over the world improve the value of their business. The way we do that is through a community of certified value builders. These are trained experts on helping you improve the value of your company. And so you've been invited to the session by one of those certified value builders. If you'd like to know how you score on the 8 key drivers of company value, what your value builder score is, Go back to the person who invited you to this session, that advisor who said, hey, you might be interested in this webinar. Ask them and say, hey, I just heard the webinar Warlow's on about the Value Builder score. How do I get mine? At the very least, you know where you sit on this 100-point scale. You're going to get a score, and then that's the starting point for helping to improve and drive up the value of your business.
Hey, Kalis, the other half of the Kalis Brothers duo. We hope these case studies and research results were as eye-opening and inspiring to you as they were to me and Dan. We get so excited hearing about the 8 key drivers because they're prescriptive in nature, so that any company can optimize each of them. And they're statistically proven to contribute far more than any other changes in driving up the sellable value of your business. And this is from empirical research done on more than 40,000 privately owned businesses. Frankly, there are actually a lot more strategies and tactics within each of these 8 drivers that we didn't even have a chance to cover in this presentation. Even if you don't plan to exit and sell your business in the near future, optimizing these 8 areas will make your business way more enjoyable, profitable, stable, and scalable, and takes all the guesswork out of the question you might be asking, will I ever be able to sell my company for anything, let alone to get back all that I put into it? Valuation of any company is made up of 2 distinct parts, and most people only ever pay attention to the first and more obvious one, earnings. Earnings are improved by increasing sales and reducing expenses. This is the quant or the quantity part. It's the numbers, the financial metrics. Thankfully, my brother Dan and I also have extensive experience with increasing earnings through our years of digital marketing experience, having built and run systems and campaigns that generated us and our partners millions of dollars over the past several years. When those types of revenue-generating methods are implemented through digital marketing into the average company, it's not uncommon to rapidly increase your earnings by 2 times, 3 times, or even 5 to 10 times earnings. But this is only half the battle as a business owner. The second and equally important element of valuation and sellability is your multiple of earnings. The multiple of earnings, which typically ranges from 0 to 5 times with most small businesses, is a factor of the profitability that an acquirer believes your company to be worth. In some cases, instead of the average 0 to 5 times multiple, a company could yield as much as 20 times or even 50 times after becoming aware of the 8 key drivers and working to optimize each of them. And again, these are statistically proven methods, not just the theory. The earnings portion of your business is essentially what your business looks like from the exterior, while the multiple of earnings you receive from an acquirer is all about the internal factors, the foundation of your business that most people can't even see. Focusing on the earnings without paying attention to the multiple would be like assuming that every skinny person in the world was healthy. We know for a fact that that's never true, that the ultimate health of a human is determined by what's going on inside. Your business is no different. When you significantly increase both earnings and multiple of earnings, you can really create substantial wealth as an entrepreneur. In fact, John Warlow said, there's simply no better way to become wealthy in America than successfully exiting a business. So, the first step in this process is learning what your sellability score is and increasing it over time. The sellability score is a measure of your score on each of the 8 key drivers. At the end of the day, entrepreneurship is about freedom. You are either seeking freedom in your business, which has you remaining the owner, but exiting from the day-to-day operations, removing your company's dependence on you, opening up the ability to rapidly scale, improving cash flow, and enjoying the fruits of a well-oiled, self-managing, income-producing machine. Or you are in the mode of planning your freedom from your business, exiting from the company and preparing for a sale to a third party at top dollar on your terms so that you can enjoy the next chapter of your life or to take care of some unplanned life challenge. Proper exit planning like this ensures that you won't be like the 80 to 90% of business owners who get to their inevitable exit day and walk away with nothing to show for all the blood, sweat, and tears. Regret is a terrible thing. It's sad, but it's easily preventable. As we often say, ready or not, exit will come. So the only thing left to do at this point is click the button below and schedule a 30-minute discovery call with us so we can take you through our 16-minute interactive questionnaire to get your company's overall sellability score. This way, we can let you know some effective strategies for optimizing all 8 drivers in your business, especially the ones that need the most work. The second half of this call will be more of an opportunity to learn about your goals, motivations, and challenges as a business owner. We look forward to hearing from you soon.